And now I would like to introduce today's speaker. David Brunori is a lawyer, journalist, author, and educator who specializes in tax and government issues. He's a nationally known state and local tax expert who regularly speaks before practitioners, revenue departments, and legislators. When he is not practicing law, he is a research professor at the Trachtenberg School of Public Policy and Public Administration at the George Washington University, where he teaches courses in state and local public finance and fiscal federalism. He also teaches state and local tax law at the George Washington University Law School. In 2013 to 2014, he was a member of the District of Columbia Tax Revision Commission. He was recently named a fellow at the American College of Tax Counsel. Now I'll turn it over to David.
Good afternoon, everyone, and thank you, Kathleen. Only my mother usually says nice things like that. The folks, Kathleen mentioned the Trump administration. I don't know if the folks online can see this, but I'm sporting my "Make Taxes Great Again" hat because we are at Quarles and Brady going to make taxes great again. If you'd like one of these hats, let me know. I can get one for you. But now I'm going to take it off because the folks in D.C. think I look silly. I'm honored to be part of this training effort being offered by Quarles and Brady. And I want to welcome all of the non-Quarles and Brady folks we have here today, friends of the firm, clients, and potential clients. And I will try to make this an hour well spent. In fact, it will be an hour because I have my Fidel Castro speech here. So bear with me. The purpose of today's session is to provide an update on the state of state taxation. I realize that not everyone attending is a tax guy or gal. So I'm going to talk technical tax in civilian terms. If you need more information about anything we talk about today, please give us a call. I'm going to focus on how all of this affects business, because that's where, after all, most of our clients and your clients are. That means we're going to miss some of the fun state policy discussions that are going on throughout the country. For example, there are proposals in 30 states to raise cigarette taxes and earmark the revenue for education. I personally think that's awful tax policy. And think about the perverse incentives that creates. I always say if I were a teacher whose raised depended on cigarette tax revenue, I'd be leaving cartons of Lucky Strikes on every kid's desk. But alas, we're not going to talk about state taxes on marijuana or violent video games or guns or prostitutes or anything like that, maybe at the next BLT session. Before we begin talking about the meat of the discussion, there's a couple of things you should know just because you are citizens of this great nation. Oh, that's me. Most American businesses pay more in state and local taxes than they do in federal taxes. Most people don't know that. Remember, businesses are paying some combination of property taxes, sales taxes, income taxes, excise taxes, severance taxes, license taxes, and a whole bunch of taxes you've probably never even heard of. So it matters to the bottom line. American businesses pay a lot in state and local taxes. How much, you're wondering? In fiscal 2015 basically, American businesses paid $707 billion in state and local taxes. That's about half of all of the state and local taxes collected in the nation. And one of my pet peeves, I hope you remember, if you take nothing else from this discussion, is that businesses don't actually pay taxes. Most of you know this. But people pay taxes. Every tax on a business entity is paid by either the owners of the company through lower returns, the customers of the company through higher prices, or the employees of the company through lower wages. So keep that in mind as we go forward. Another thing you should remember is that state and local taxes are complicated. There are 50 states, 97,000 local taxing jurisdictions. Some states tax sales, about 45 of them. Some states tax income, 41-ish. Some states tax estates. Some states tax gross receipts. And, of course, the base, what we tax, and the rates are different everywhere. Why does this matter? Because if you're doing business across state lines, you need to know what the law is. Like modern families, state and local taxes are complicated. But wait, there's more that you should just keep in mind. State and local governments always need money. Raising tax rates is politically difficult. The result is that revenue departments, and we have a few in attendance today, are more aggressive than ever. And I don't even mean that in a pejorative sense. They just are. Audit rates, especially for multi-state businesses, are up. Litigation rates are up. There is a strong incentive to get it right. Because if you don't, you're going to spend a lot of time and money fighting the tax man. That's just a fact. And solid planning can mitigate the risks of audit and litigation. And a practice note, states have been sending out what they call Nexus questionnaires to out-of-state businesses. And basically, it's a questionnaire that asks a bunch of questions, and they're trying to get the company to say whether the state has taxing jurisdiction over them. If your clients get one of these questionnaires, they should call us or call someone. Ignoring the questionnaires or filling it out wrong can lead to a whole world of hurt. And we're seeing this around the country. Finally, and by the way, I apologize for our boring PowerPoint. I don't do PowerPoint very well, and I had a lot of inappropriate pictures in my PowerPoint that the firm asked me to take down, I think, appropriately. Finally, what we're going to talk about today is that state and local taxes change frequently. And they change administratively through regulation much more than they do at the federal level. State and local politicians are always looking for ways to either raise revenue or provide incentives of some kind to businesses to get them to invest. So there's a lot going on, and companies need to know that. On average, there are over 1,000 substantive changes to state laws and regulations every year nationwide. And it is actually a great advantage the revenue departments have over companies engaged in interstate commerce because they know the law and you don't. But you and your clients need to know which of these changes affect your rights and responsibilities. We always hear the term ignorance of the law is no excuse. Well, that's more than a cliche for state revenue departments because they don't really care if you're ignorant of the law. If you owe the tax, you owe the tax. So it's something to keep in mind. All right. Let's go to our first substantive discussion. And it all starts in Washington, where we are right here. I get asked all the time, what will federal tax reform mean for the states, and in particular, for a company's state tax burden? And I really wish I knew the answer, but I don't. As of today, there is no federal tax legislation in the pipeline. The administration has an outline of a plan. It would broaden the base, i.e. tax more things, and end a lot of deductions and preferences, but lower the corporate rate significantly, down to 15% at least, according to their initial plan. It would also lower the personal income tax rates and curb a lot of personal deductions. And that will, of course, affect a lot of businesses. The House leadership, as many of you know, has a much more ambitious turn the system on its head plan. And that plan would radically change business taxation in the United States. Most of you have heard of the border adjustment. The House leadership would also lower the rates to 20%, and almost every deduction for business would be eliminated, including the interest deduction and a lot of other things. I do not think. Well, first of all, let me tell you, tax reform will happen this year. I'm convinced of that. They will do something. I just don't think that whatever comes out is going to look exactly like what the president initially planned or what the House initially planned. There's too many complications. If I had a bet, I think it would look more like the president's plan than the House plan. But honestly, we really don't know. Some of the details are mind-boggling. Even in the president's plan, we will see deemed repatriation, maybe a pass-through business income tax like they have in Kansas. And this matters, and it matters to our clients and your clients because the states all use federal taxable income as the starting point for both corporate and personal income taxes. So what the federal government does matters a lot for your state tax burdens. Two things you can expect. First, both the president and Speaker Ryan's plans indicate they would like to do a lot of base broadening. They're going to tax more things, eliminate deductions and preferences in order to lower those rates. That's the goal, is lowering the rates. That means your state taxes will go up unless the states decouple, unless the states don't follow the federal government. Most red states will follow the federal government on these matters, no matter what happens. But there are states like California and Hawaii, Rhode Island, and a few others who have all said right up front, we're not going to change anything. If federal tax reform results in more state revenue, that's a good thing. The second thing you should keep in mind is that both the president and the House leadership want to repeal the federal estate tax. And it is almost certain that this will happen. I talked to a former student of mine recently who works for Senate Finance, and he told me that with all the uncertainty up there on the Hill, they're pretty certain about this. If it's repealed, it will be difficult for the remaining states. There's about 15 states that still impose the estate tax to keep imposing their tax. So that will trickle down as well. My advice, however, free of charge, is not to worry about this right now. There's going to be plenty of time to pay accountants and lawyers later, believe me. But right now, since we don't really know, everything is speculative. And there's law firms out there, I will tell you, and I'm glad Quarles and Brady's not one of them, that is selling all kind of speculative advice. And it is not worth it because you really don't know. All right. There's a couple of other federal issues we should mention that are going to affect the states. Are you sleeping? All right, you will be. On the federal front, there's been a lot of attention paid to the so-called Section 385 regulations, which most of you don't know what they are, but they address related party debt. And basically, the IRS could start treating intercompany debt as equity and deny deductions for interest. And that's a big deal because that's a favorite planning tool. Companies lend related parties money all the time. They lend losing subsidiaries money. They deduct the interest. The losing subsidiary doesn't have any income anyway. It's a big shell game often. And then sometimes there's legitimate business reasons as well. And the big question is whether the states will conform to Section 385 regulations. The regulations came out in October. There is some talk that the Trump administration might repeal them. It is also possible that federal tax reform repeals the deduction for interest completely, so all of this will be moot. But it is definitely worth following if you or your clients have intercompany debt. There's no doubt about that. And then there's the partnership rules. There's a new federal partnership law and coming maybe regulations that would force partnerships to pay an entity-level tax. And this is kind of revolutionary for the United States. The law goes into effect in 2018. It's a little complicated, but if you have partnership clients, this is an opportunity to advise them on the ramifications of the federal law and keep an eye on what the states may do. Arizona, for instance, I think is the only state so far to conform to the federal law. So they're going to follow whatever the federal government does. But that, I think, is the only state so far to do that. The IRS promulgated regulations that were withdrawn when the new administration came in. And federal tax law changes may make some or all of this moot. It's really unclear. But the bottom line is that partnerships will likely be audited and have to pay tax at the partnership level, not at the partner level. And why this matters? Well, under the new law, the IRS can conduct an audit in an open year, 5 years ago, 7 years ago, depending on what's open. And the partnership as an entity currently is on the hook in the year of the audit, not when the tax liability occurred, to pay the tax. So if you think about what that means, partners come and go in partnerships, and a partnership may incur a tax liability, and some of the partners are gone, and you have new partners coming in. So it's going to be kind of complicated. Luckily, we actually have some folks at Quarles and Brady who know this very well. We'll tell you about that a little bit later on. Also on the federal front, and perhaps more important because it's much more pure state tax stuff, you should be aware of the Mobile Workforce Act. This is likely to pass. And why it's important, right now, this is actually kind of crazy. Right now, states can impose personal income tax liability on anyone who works in a state, even for a day. This means that person has tax liability in that state, and the employer can have withholding responsibility anywhere the employees are, where they show up for a day. So you think about that. I'm going to visit a client in New Mexico on Monday. I'm going to be there for 2 days. New Mexico could send me a tax bill for 2 days of my salary. They could also send a tax bill to Quarles and Brady for those 2 days of my salary. Most companies don't even know about this, and if you're dealing with 50 states, it's actually pretty complicated. There's about 30 states that if you show up one day, you're on the hook for the tax. Some states like Wisconsin set a threshold, but the Wisconsin threshold, I think, is $1,500. So it's not even that much in terms of salary. The new law, the Mobile Workforce Act, would prevent states from imposing taxes unless you were in the state for 30 days. Right? So at least it's a clear, right-line rule. If you're in the state for 30 days, you owe tax. Like I said, this is very likely to pass. The states don't like it because they don't like any intrusions on their taxing authority. And I'm sympathetic to that. I think we should look at preemption warily. But this is a very good idea. If you're going to preempt something, this is a good thing to preempt. In any event, our clients, your clients, everyone should know about this because it actually matters. And some states are actually very aggressive about it right now. So something to keep an eye on. Okay, let's get into more state-specific stuff. All right, we're going to talk about the sales tax first, and I'm going to give you a little refresher for those of you who don't know a lot about sales taxes. Way back in 1992, the U.S. Supreme Court, in a very famous case called Quill versus North Dakota, held that states cannot force a vendor, a seller, to collect sales tax unless the vendor has a physical presence in the state. Many of you know that. If you are not in the state, you don't have to collect the tax. And the states have, all of them, all 45 with the sales tax, have hated it since day one because the ruling has cost the states billions of dollars in lost tax revenue. And here's why. Because the sales tax works because the vendor collects it. If you go to the mall and buy something, the store collects the sales tax and they send it to the state. So the sales tax works in that regard. But I don't know if you knew that if you buy something online or through a catalog or in Montana that doesn't have a sales tax and don't pay sales tax, you personally are on the hook for paying use tax. Some people know that. A lot know it and ignore it. And if I asked here, and I'm not going to ask because I'm not going to ask a room full of lawyers whether they're breaking the law, that if you ever bought anything online, most of you would raise your hand. And if I said, have you ever paid a dime of use tax? A few of you might say yes. Most of you would say no. Mainly, some of you don't know. Some of you forget about it. Anyway, I'm not asking the question. Truthfully, from a good tax policy perspective, and I'm a good tax policy guy, you should be paying sales tax on your purchases. Because otherwise, the tax rate on everything else you pay is higher, right? I would be happy to have another session on the principles of sound tax policy to explain why all of this is the way it is. Just invite me back. But because the Quill decision was based on a Commerce Clause, a lot of people thought that Congress would go in and fix it. And Congress can't overturn it at any time. And there have been many bills, probably 7 or 8 over the years, but no passage. Some of you have heard of the MarketBased Fairness Act. That's the most recent congressional effort. And that would allow states to require sales tax collection on remote vendors. But that's not going to pass. Nobody thinks it's going to pass. So, the real story is this. The states are taking it upon themselves to try to get Quill overturned. 3 states have enacted what we're calling economic nexus laws that require out-of-state vendors to collect sales tax if their sales into the state meet some certain threshold. Usually it's $500,000. In a couple of states, it's $200,000. Those states are Vermont and South Dakota, and it's not up here. I'm not sure what's up there right now because I can't read the screen. And North Dakota. North Dakota passed it this week, just to show you how things are changing all the time. This week they passed it. Alabama and Tennessee have done the same thing through regulation, and Massachusetts is somewhere in the process of trying to do it through regulation. And in these states, again, if your client or our clients have sales totaling more than whatever the economic nexus threshold is, they have to collect sales tax, even without a physical presence in the state. Now, as long as Quill is good law, that 1992 case, those laws and regulations are clearly unconstitutional. Clearly. And there's lawsuits being filed all over the place in those states. And in fact, this week, just to show you that things are always happening, a court ordered the Tennessee regulations to be put on hold until some of the litigation plays out. There are proposals, there have been or will be proposals in at least 17 and maybe 20 states to adopt this so-called economic nexus. It's been rejected in a few states while they wait to see what happens in some of the litigation. Part of it is motivated by the states needing money. And what a lot of states are doing is passing these laws and in some cases, budgeting the extra revenue, banking that Quill will be overturned. New York recently wanted to tax all online marketplaces like Amazon and eBay, anybody who had $100 million of sales or more into the state. That effort failed. They're going to try it again, and a couple of other states are thinking about doing that. There's one other twist to the story, and that is it started in Colorado. To force collection tax on remote sales, Colorado passed a law that requires out-of-state vendors to report to the Department of Revenue the names and purchase amounts of all sales into the state. I have a lot of problems with this from a privacy standpoint, but leave that aside because that's been upheld. The idea is that vendors will forego the reporting and just collect the tax because the reporting's painful also and burdensome. Or the department will have the names and the amounts of everybody in their state that bought stuff, and they can go out and send letters saying, hey, you owe use tax in our state. This has been upheld by the U.S. Supreme Court. And Washington, Oklahoma, and Kansas last week passed similar laws. So you got to watch it. If you are selling into Colorado, Washington, Oklahoma, or Kansas, you may need to report your sales to the state. And a couple of the states have some threshold amounts we'd be happy to talk to you about. But it's certainly worth following. Why are the states doing this? Well, the states would like to see Quill overturned. And they're going to give the court the opportunity by passing clearly unconstitutional laws, right? Quill said X, they're going to pass a law that says Y, and they're daring the court to overturn it. But there's been indications by some Supreme Court justices, certainly Justice Kennedy, that they'd be willing to overturn Quill or certainly revisit it. The second reason, as I said, the states need money. And this is going on even in the most conservative states because they need money. And, you know, if they make an out-of-state vendor collect a tax, that's okay. There's a perception that that's okay. No one believes Congress is going to do anything about it. And finally, a little bit of a wild card, Amazon is now collecting sales tax in every state in D.C., every state that has a sales tax in D.C. It is by far the biggest remote vendor in the world. I don't know about the world, but certainly in the United States. And the states are betting that no one else has the clout to carry the fight on. Now, what they're finding out is some smaller companies are actually carrying on the fight. But Amazon's sitting on the sidelines. And I actually think that Amazon collecting tax in every state is a very big deal. In fact, I wrote an article about it this week that I'd happily share with anyone who'd like to see it. Just email me discussing this. Amazon accounts for about 60% of all online sales in the U.S. And if they're collecting the tax, the states have already won. I mean, the states have already essentially won. There's a couple of other big ones. But most of the other vendors are small, and the states are never going to be able to go after them anyway. It's certainly not efficient. In any event, most people think this will get to the Supreme Court. A lot of very smart people think there's a good chance Quill will be overturned. But in the meantime, our clients should be aware that states have passed these laws and are being, in some cases, super aggressive about it. And companies will have to collect a tax or fight it. And there's a nightmare scenario down the road. If the court overturns Quill and Congress doesn't do anything, you may see 45 different sales tax regimes around the country with different basis of what's taxable and what's not, and different rates and stuff, and it'll be difficult. What it means for you is that if a company's selling into one of these states, the Revenue Department is going to expect the firm to collect taxes if it meets the requirements. Do not ignore this. Know what the thresholds are. Know if you have a physical presence or a presence that a Revenue Department will think is a physical presence. But you got to know these things because if you don't collect the tax and you're supposed to collect the tax, you are on the hook for the tax. And that alone is worth paying attention to. Okay, we're going to move on now. Watch the cat. What does that mean? Well, what it means is if you have clients doing business in Ohio, this is sort of related to what we were just talking about. You should be aware of the commercial activity tax, or CAT, as we insiders cleverly call it. The CAT is essentially a gross receipts tax. It's imposed on all sales into the state over certain thresholds, but it applies basically to everybody selling into Ohio. And a lot of people sell into Ohio, including a lot of our clients. A recent decision by the Ohio Supreme Court in a case called Crutchfield, actually a very important case, said that companies with no physical presence in the state were liable for the commercial activity tax. Right? So you could be a Wisconsin company selling into Ohio, just selling products into Ohio, no physical presence whatsoever, and be on the hook for the commercial activity tax. Some people think that this case will be used as a vehicle to overturn Quill. But the important thing to note, I'm not sure if that's the case, by the way, but the important thing to note is that if you're doing business in the state, look for a CAT bill. The Ohio Department of Taxation is extremely aggressive on this front. They're going after out-of-state companies every day. Luckily, ladies and gentlemen, Quarles and Brady has some experience in dealing with CAT issues, so feel free to give us a call. By the way, as an aside, because I can't help delving into tax policy, the commercial activity tax is, yes, a gross receipts tax, and that is an awful, horrible way to collect revenue. It is among the most cynical ways to pay for government, because a gross receipts tax basically cascades, and you tax every transaction in the state, and it is all passed down to the consumer secretly, hiddenly, hugely, in the form of higher prices, and they don't know it. And it's really an awful way. Nevada does this, and Washington, state of Washington does it. Oregon and Louisiana are thinking about it, and obviously Ohio. And this tends to be the trend because the corporate income tax doesn't work very well, and states need money, and they're looking at this as a cash cow. So something to keep in mind. All right, moving right along to digital goods. Digital goods. This is a big sales tax issue of which we should all be aware. It's also a big income tax issue for a lot of folks. And I believe that state, and to some extent local governments, will continue to be aggressive with respect to taxation of digital goods. In fact, I've talked to numerous revenue directors over the last year who all say that this is the number one issue as far as they're concerned. And there's a lot of confusion about this, but traditionally, states did not impose the sales tax on digital goods. All they taxed was tangible personal property. And, of course, all those sales taxes were written in the 1930s, long before there was anything called digital goods. And then one day, the states woke up and said, wow, our sales tax base is shrinking. What are people spending money on? And they said, oh, digital goods. And then light bulbs went off, and they said, wow, we got to figure out how to tax them. The legislature still don't want to raise taxes. There's this politics of anti-taxation around the country. There's wariness about raising taxes on them. So a lot of states are actually looking to their revenue departments to figure out how to tax digital goods. And that's a little bit controversial, but there's a lot of confusion. So, for example, Arizona, and I know we have folks from Arizona here today, the Arizona Department of Revenue recently ruled that selling cloud storage space is actually akin to selling tangible personal property and subject to sales tax. Right? And that was a little revolutionary in Arizona. New York Department of Taxation and Finance actually reached the opposite conclusion. And California, by statute, mainly because I think of the high-tech firms, actually specifically does not tax digital goods. But about 20 states do, in addition to Arizona. And this has created all kinds of issues for everyone who sells services online of any kind, whether it's games or apps or Airbnb or Uber or whatever it is, anything you're ordering over your phone or your computer, whether you're a business or individual, it's something to be thinking about. Interesting ruling out of Iowa earlier this year. It sort of illustrates the problem, right? So Amazon Prime, I don't know how many folks in the audience are Amazon Prime members. I know some of you are. The Iowa Department of Revenue ruled that Amazon Prime is subject to sales tax, right? That's a digital good. You are subject to sales tax in Iowa. Why? Well, because Amazon Prime offers Amazon Video. And in Iowa, all pay television is subject to sales tax by statute. Iowa also has a statute that says if one part of a bundled service is subject to tax, the entire transaction is subject to tax. So under the law, I think Iowa got it right. In fact, I'm certain they got it right if you read the statutes. Although there's a lot of lawyers saying, they didn't, and I think advising clients that they didn't. But I think they got it right. But it just illustrates how the world is changing and how departments of revenue are viewing this. And it's really a case-by-case situation. And this is going to be all-consuming. And it's something to watch because traditionally, again, states did not tax digital goods. And because politicians don't like to raise taxes, there's an expectation that the departments of revenue will somehow go after the money, and there's a lot of money there. All right. We're going to switch gears and talk a little bit about some income tax issues. The big income tax issue that folks should be aware of involves something called market-based sourcing. And if you're not a tax guy or gal, you're probably looking at me like a puppy, wondering what the heck I'm talking about, and that's okay. But this has been a hot topic for the past couple of years, and certainly will remain so through this year and a few years to come. Traditionally, states used three factors to determine corporate tax liability. States looked at where you own property, where you had payroll, where your employees were, and where you made sales. And they had formulas that you plug in the numbers of your property, payroll, and sales to determine what your tax liability would be in every state, right? So there'd be some fraction in this state, in this state, in this state, because all of those things were thought to add value to the enterprise. And for 100 years, with a couple of exceptions, this has been the case, and it's starting to change now. But one of the big changes recently is that the sale of services used to be sourced where the services were performed. So if I'm an architect and I live in Virginia and I do work for somebody in New York, for corporate tax purposes, those sales are happening in Virginia. That was traditionally the way it always was. But the trend, and this is very important, has been to change the law and source the sales where the services are consumed. So in that example I just gave, the sales are now taking place in New York, not in Virginia. And this is a radical departure for corporate tax purposes. 21 states and D.C. have moved to this market-based sourcing, and I think 4 other states are considering it this week or maybe early next week. And most states have moved because they do a calculation that they are going to raise more revenue. I am doubtful of that. But Arizona and Missouri still use the traditional cost of performance, that old way, but allow an election to use market-based sourcing. This also coincides with a trend to adopt what is known as single sales factor formulas. And what that means is instead of looking at property, payroll, and sales, they just look at where your sales are. So all of this is actually changing the way we think about corporate tax in the country. And it's complicated. And if you're a state exporting services, you're probably losing money. But here's what the big issue is. The law says that the sale is sourced in the state where the benefit or services received or consumed. Well, what does that mean in a high-tech digital world? Where are they consumed? And think about this for a minute. Say you're a company in Wisconsin and you sell a service basically defined as anything that is not a tangible personal property that is used by a customer in 20 states. Well, which state is using, which state gets to tax the corporate income from that? What happens if the purchaser of the services is in Wyoming with no income tax? But the users are actually in New York, right? The purchaser could be in Wyoming, but the user's in New York. What happens if the provider of the services is in a traditional cost of performance state, and there's still 20 of those, 24 of those, but you're in a market source state, right? So it's complicated where all of this will play out. And this affects traditional service providers, but even more so financial institutions or digital service providers whose customers are far more difficult to identify. And that's the key, is you can't identify who's using it. That's a problem. And remember, the burden's always on the taxpayer to prove that they're getting their return right. I have a list of market-based sourcing states if anybody would like them. There's a bunch of proposals still in the pipeline. I'll happily share those with anyone who wants them as well. From a planning perspective, this does not matter much, honestly, because you're going to sell to your customers wherever they are. So you're not really going to change your basic business model because of this. But it will affect your tax liability and where you may owe it, right? And that's important. So if a client is selling a service, including digital goods, a change in the sourcing rules can significantly change their tax burdens, state tax burdens. And it's certainly something worth keeping abreast of. Okay. How are we doing on time? Okay. How many minutes? 15. Wow, I have 80 more minutes of text here to read. All right, let's talk about incentives for a minute. Yeah, that one. Talk about incentives for a moment. This is actually very interesting. At the beginning of this year, maybe in the middle of last year, everyone thought there would be a significant slowdown in the granting and use of tax incentives by state and local governments. Everybody was predicting this. And I must confess, I sort of cheered that on. Many of our clients use incentives, and they should take advantage of every incentive offered to them. But it would be nice to have a tax system and an economic system that did not require incentives. That would be a good thing in many respects from an economic development perspective. But there was a lot of thought that the tide was turning against what was a plethora of incentives, thousands every year across the country. And what was driving that was there was a lot of academic research that showed that most incentives, honestly, were unnecessary. That businesses were probably going to do what they were going to do, whether they got the incentive or not. And the incentive's a nice thing, and you should get it. You should ask for it. But there was a lot of surveys of CEOs who said, yeah, they matter on the margins. So that's an expensive deal, though, because we spend billions of dollars in incentives. So there was some concern about that. Second, many Republicans in the country, and the Republicans basically run 38 of the states right now, are philosophically opposed to most incentives, right? They don't like the idea of government picking winners and losers and interfering in the marketplace and all that other good stuff. So there's a lot of people who said, well, maybe you'd see a pullback on incentives. And honestly, after 40 years of ramping up incentives, there was a little bit of incentive fatigue around the country at the state level. And in fact, at the beginning of this year, there were proposals in Arizona to scale back the GPLET. Folks in Arizona may know what this is. Certainly, my friend Don Gable does. Proposals in Maine, Utah to scrutinize existing programs. I think there was even a proposal. There was certainly one in Missouri. I think there was one in Wisconsin as well to sunset all incentives and then revisit them after the sunset. So there was a lot of movement on that front. And guess what? Despite all of that, 2017 will be the year of the most tax incentives handed out by state tax governments in the history of mankind, by far. States will give out more money in tax incentives this year than they ever have before. Incentive fatigue? Are you kidding me? We're rocking and rolling. The last week, Maryland, mimicking New York. Some of you may be familiar with Startup New York. Maryland just passed a law that says if you're a manufacturer and you move into certain areas of Maryland, you will pay no state taxes for 10 years, not a dime of state taxes for 10 years. And it's going to cost a lot of money. And that's, they think that will attract a lot of businesses. Again, New York has a similar program. Michigan passed a law last week or 2 weeks ago, mimicking Illinois, which started all of this, that allows companies. Here's the big problem. Corporate income taxes are not collected very well in this country, and there's a lot of ways to minimize your corporate tax burden. And there's an old joke that says, if you're paying corporate income taxes, you need to find a new accountant and tax lawyer. And so if big companies are not paying corporate income taxes, what could you give them as an incentive? Well, I'll tell you what you can give them. You can let them keep the employees' withholding. So what Illinois does and what Michigan just passed is instead of handing over your income tax withholding to the state of Illinois, or in this case, the state of Michigan, the corporation can keep it as an incentive. I'll leave it to you to decide whether that's good or bad from a policy perspective. One thing is for sure, you should be taking advantage of it. That's clear. The Oakland Raiders will be moving to Las Vegas as a result of a big, giant tax incentive. And actually, just, I don't know, it was in the last week or so,
even at the local level, a Texas school district agreed to forego $1.2 billion in property taxes for Mobile if Mobile built a new plant in the school districts. They needed the school district approval for the property tax abatement, and they said, "Yeah, sure, we'll give you $1.2 billion." So it's a crazy year of incentives when everybody thought it would be just the opposite. Here's some more free advice for you, though. There are literally thousands of incentive programs out there. In some states, you can get incentives long after you've done whatever it is they were trying to incent you to do, right? So you can get incentives retroactively. We'll leave aside the definition of incentive for a moment, whether it's appropriate or not. But what you should think about doing, and I tell people this all the time, you should do a little audit of yourself to see if you're leaving any money on the table. Because in my experience, there's lots of companies leaving money on the table with respect to tax incentives. There are so many and around the country that it's actually kind of crazy. Okay. We're going to talk for a minute, and then we'll open this up to questions. Give me another minute. I want to talk about local taxes for a moment because there's a lot of action at the local level that will affect businesses around the country. And this depends a lot on whether local governments, how much taxing authority local governments have. So in Wisconsin, for instance, I don't think local governments have much authority apart from the property tax. But in a lot of states, they do. And here's what's happening. States are broke, and so they are giving less money to local governments in the form of intergovernmental aid. And second, the Republicans control most of those states, so they're not raising taxes to spend money on what Democrats would like to spend money on. But in a lot of big cities are controlled by Democrats. So what we're seeing is more liberal political leaders trying to get their cities to advance agendas that their state governments will not advance. And the classic example is Portland, Oregon. Portland, the city council passed a law that says, this is in the name of income equality. In Portland, Oregon, if you're a Fortune 500 company, actually, if you're any publicly traded company, and you pay your CEO more than 250 times the average worker's pay in your company, you owe a 25% tax in Portland. A lot of people don't even know that, so we should know that if we're doing any business in Portland. There are similar proposals in about 18 other cities to do exactly that. Now, I think what the result will be is companies will all move to the suburbs and avoid this eventually. I don't think it's going to work, but it's the law. Certainly in Portland, it's the law, so we should be cognizant of it. San Francisco is trying to impose an income tax on high-income folks. There's a lot of this going on in California to impose business and income taxes for a lot of what I think good things. I don't think this is the way to do it, but for the homeless, for education, drug rehabilitation, all kinds of what I think good public policies. It's just I don't think local income taxes are the way to go because your rich folks move out of town is what happens, and that's pretty clear. Property taxes. One thing you should know, pretty quiet in recent years in most states. Exempt organizations, we have a big exempt organization practice here at Quarles and Brady, a very good one. The federal law is not going to change on exempt organizations. Neither the House nor the Trump administration want to end federal exemptions. But one thing you can expect, and I'm going to end on this note, is a lot of local governments are being aggressive on the definition of exempt property. So in the District of Columbia, where I am right now, D.C. is actually pretty aggressive looking at universities and hospitals and stuff about what is exempt and what is not, because they're trying to squeeze the non-exempt part of it for property taxes. I'm going to stop there. In closing, I just want to know we have some terrific capabilities in the tax field in general and in state and local tax in particular here at Quarles and Brady. My partner, Don Gable, who's in Arizona, one of the leading state tax litigators in the country. The same is true of John Barry in Milwaukee. I'm not sure if he's in Milwaukee right now. But we have some very high-level talent also in Milwaukee, Pat Hentz, in Chicago, Ed Hannon. We can assist with planning, audit defense, policy analysis, and, of course, litigation. So give us a call. And I want to thank the business group, in particular, Liz Orla, for allowing me to do this today, the tax team, Haley Musgrave, and especially all of you. And I have one question. I only have one question on the leaderboard. If anybody has questions over the mic, you can ask. But the question is the cat the same as the VAT? And the answer is no. The VAT, actually, the cat is an anti-VAT. Because what a cat does, with a commercial activity tax or a gross receipts tax does, it taxes every transaction at every step of the economy. So a wholesaler is taxed, the manufacturer is taxed, everybody's taxed on their sales. So that keeps pyramiding. Those taxes become part of your cost of goods sold and keep pyramiding. The beauty of the VAT, which we don't have in the U.S., but most of Europe does, the beauty of the VAT is it exempts or gives you credit for previously paid taxes. So the tax only falls on the final consumer ultimately. So this tax is levied at every level, and that's a bad thing because it's all hidden. The VAT is actually a good thing. So the VAT is the anti-VAT. The cat is the anti-VAT. VAT. So does anyone else have any questions? Scott, Larry? Folks in Milwaukee? Kathleen? Oh, there she is. All right, I'm done. Thank you all very much.